Well, welcome everyone. We're going to get started. Good afternoon, everyone. Welcome to the series Mud Talks, How to Divest from Fossil Fuels and Invest in Clean Energy with Tom Konrad, class of '87. My name is Vanessa Chu, Assistant Director in the Office of Alumni and Parent Relations. We thank you for attending today's event, and we hope you and your family are safe and healthy during this time. This talk is being recorded and will be distributed along with presentation materials after the event. Please feel free to type your questions in the Q&A box, not into the chat, and we will try to get through as many questions as we can after the presentation. Now, to briefly introduce our speaker, Tom Konrad is a financial analyst, portfolio manager, and freelance writer specializing in renewable energy and energy efficiency investing. He writes about investing in clean energy for altenergystocks.com and freelances for publications including Green Tech Media, The Guardian, and Forbes. I now turn it over to Tom. Tom, take it away.
Hello, everyone. I'm just going to start in on the presentation here. So I've been doing divesting from fossil fuels, actually investing. My specialty is actually investing in clean energy, but divesting is more for everyone. This is not investment advice. This is the legal disclaimer. I am not an investment advisor. So if you wanted to have personalized investment advice, you have to go to someone who actually is licensed to do that. This is more how I would go about it if I were in the situation I'm guessing you are in, if I had a normal portfolio and wanted to get into it. My background, I've been doing this since basically doing this as in investing in clean energy stocks since 2006 as my sole focus. I currently manage a private portfolio for a family office, which we're working on turning into a hedge fund, which I expect to launch in the first half of next year. I consult for a couple investment advisory firms on their strategies, and then I also write about this. I was mud math and math for a PhD at Purdue. And after that, I got the Chartered Financial Analyst designation, which is for portfolio managers. It's something you'd look for someone who usually manages a mutual fund. I also volunteer for my town in New York, my New York town of Marbletown, where I've been helping them basically improve the environmental impact of the town. And we've saved the town a lot of money too along the way with energy efficiency measures such as LED streetlights and just taking a bunch of streetlights out, as well as improving some of the town's buildings. So on the subject of divesting, the first reason is there's actually a lot of reasons to divest from fossil fuels, and you're probably coming here with one or more of them, but most people think, well, we just don't want to be part of the problem of climate change, which is a big deal. So when you invest in a company, what that company does is something you are aiding and abetting. You're funding whatever that company does. And a lot of people think of investing in the stock market as passive, and it is passive, but you're still aiding and abetting. It could be in a small way if you don't have much money, but on a moral, if you take a moral approach to it, it doesn't matter whether it's a small way, or not. The other moral piece of it is if you're also an advocate like me and you want to create change, political change, it's a lot harder to create political change, which might hurt your investments. If you feel like you might be hurt financially, it's much easier to just align your investments with what you're trying to accomplish. And if you're an advocate only in the sense of voting, even that, oh gosh, I don't want to vote against someone who might hurt my fossil fuel stocks. Well, if you don't own fossil fuel stocks, you don't have to worry about that. For financial reasons, there's a lot of risks inherent in owning companies that are involved in fossil fuel extraction, transport, simply because the industry will end. It is ending. And as it ends, being in fossil fuels will become less profitable. As we've already seen that in a lot of it. I'll get to that later. in investing, investing is all about the future. You want to invest before the trend really takes hold. And you want to, so you buy when it looks like it's likely, but before everyone else realizes it, so you don't pay too much for the stocks you're buying. So you want to divest early. And then if you were the last person to sell ExxonMobil or whatever, who would buy it from you? Nobody, which means you don't get anything for that fossil fuel investment. I mean, that's the extreme end cases, but you do want to know that that there's still someone to sell to when you do sell your fossil fuel investments. So one objection that many advisors say is that, okay, if you throw out part of the possible investment universe, you're going to hurt yourself. History shows that that's not the case. This is a 5-year graph of a number of indices. The yellow one, SPYX, is the S&P 500 without the fossil fuel companies, while the blue one right below it is the S&P 500. So if you just owned an S&P 500 portfolio, sold the fossil fuel companies 5 years ago, you would be 8.5% richer today than you were before. If you look at focused portfolios like a coal ETF, that's this purple one, it's way down from over the 5 years. It's actually lost 4% over 5 years. It's way down over the last 3. Oil and gas exploration companies are down 67% over the last 5 years, and well, significantly over the last 3. So basically, if you were worried about getting out of fossil fuels 5 years ago and didn't do it because of that, you made a mistake. Now, going forward, they always say buy low, sell high. Aren't fossil fuels cheap right now? Well, buy low, sell high only works for stocks that actually are going up and down. There are many industries that basically are no longer with us. And this is a photo I took in Colorado, the ghost town. Colorado silver mining was not a great investment after the early 1900s. So I contend that fossil fuel extraction is approaching the end of the industry. So again, you want to get out early. It looks cheap now, but that's only on historical multiples. It's not looking at the future. So how do you do it? There's 3 basic methods of investing and managing your money. You can go to an investment advisor who will do it for you. You can do mutual funds, or you can choose individual stocks and bonds yourself. For an investment advisor, this is the simplest way to go because you'll have a professional who actually can make the decisions for you based on your needs. It's can be expensive because, well, you have to pay someone for their time. Sometimes a lot of investment advisors actually just help you with planning how much money you need to save for when, and then they put your money in mutual funds. This can be very expensive because you end up paying the advisor a percentage of your money up to say 1%, and then you're also paying the funds that money. So that can be one of the most expensive options. It may be the only option available to you because advisors who use individual stocks are fairly rare and sometimes hard to find. But if you can find one, I generally prefer that as an option if you're going with an advisor or a planner. Other things you'd want to look for with an investment advisor is, I think it's very important that they're supportive of you wanting to go green. You don't want to be fighting your advisor on whether or not to divest. And this is very similar to, it has another advantage in terms of helping the industry. If you go to an advisor who actually has green as part of their business, well, you're helping that part of the industry, which is helping to move investments in the right direction. I mean, the goal of divesting, or one of those goals I was talking about earlier, is to influence the economy. And historically, the investment advising industry, the investment management industry, has generally been part of the problem. they steer money towards the investments they believe will be most profitable, regardless of what those companies are doing to the world. So I think it's better to find an advisor who isn't going to do that with their other clients either. You want to help that advisor make money, become more prominent, become more successful, so that advisor can help other investors who might not be as dedicated as you are. You want the advisors who steer people towards fossil fuels to go out of business, because then they won't be there steering people towards fossil fuels. Generally, with an investment advisor, you want to get what's called a fee-only advisor. Some advisors are paid by commission. They'll sell you a mutual fund and then they'll get a kickback. This is legal, but can lead them to make poor recommendations. Fee-only means that you actually have to pay the advisor directly, but that way you know that they're really working for you. Just like they say on the internet, if you are not the customer, you are the product. And I already talked about advisors who use individual stocks as what I generally prefer. If you're looking for certifications in advisor, you want them to know what they're talking about. The ones on the left here are ones that pretty much everyone should have. Basically, on the left, you have to have an investment advisory firm, registered investment advisor. That's the legal designation to give people financial advice. And they employ investment advisor representatives, the actual people who go out and do that. Sometimes it's an investor advisory firm with just one representative, but a registered representative could be a representative of a broker and so forth. They're not there to give you investment advice. Their job is selling products. They're usually paid by commission, and you won't see any fees, so it's tempting, but the fees are getting kicked back to them by what they pay. Meaningful certifications for investment advisors are CFP, Certified Financial Planner. That is someone who is trained in helping you manage your entire financial life and understand the risks in your life, your income, and help you reach your financial goals. That's the one I would say, if you're looking for a certification, that's the one to look for. My certification, CFA, a Chartered Financial Analyst, is a certification that's more used for people who actually manage portfolios. It does allow us to register as an investment advisor without any other academic or certifications, because it is very rigorous. And you won't go wrong with a CFA as your investment advisor, but it's sort of not pointed in the same direction in terms of giving advice for managing your money. However, if you're looking at someone who manages individual stocks, you might want to see the CFA, because again, that is selecting investments is the core of that training. Moving on to mutual funds, we'll be looking at what are generally called ESG mutual funds, which are funds that pay attention to the holdings of their holdings in terms of environmental responsibility, social responsibility, and governance, which basically means that there are systems in place to make sure that the managers are looking out for your interests rather than their own, and also that they are not out there bribing people and breaking laws. The definitions of ESG vary widely. There's probably 100 different firms that will tell you what are ESG, which stocks are ESG, and give you ratings on each of these, but they don't agree between company and company. But generally, if it has a higher rating, it's better. The thing is that how they evaluate is different. Some companies look at, is it the best in its industry, or is it just good? You know, so like you can get a high ESG rating, environmental rating for a fossil fuel company if it actually is better than all the others by some, but then other rating companies will just say, ah, all fossil fuels are bad. So if you wanted to build a portfolio with ESG mutual funds, it's fairly easy. You need to understand the portfolio allocation you want, which could be done either with, there's some online tools for figuring out which is an appropriate allocation for you. And then you can just put in funds that meet that criteria. So you'll want a bond fund, you'll want a stock fund, and that online tool will tell you sort of what proportion is right for you or best for you. And then I'll go into how you can find funds that are fossil fuel free and may meet some of your other standards. A lot of ESG mutual funds do have relatively high fees compared to general market funds. In many cases, that's because they also do advocacy as well as just money management. And some of your fees are actually going to try to persuade companies to behave better. You may or may not want to pay for that. You might want to save your money and donate it to environmental cause. So that's it. That's a tough decision, and you really need to. You do need to understand the mutual funds you're looking at. You can do a hybrid approach with an advisor. You find a fee-only advisor who will, for a flat fee, build a portfolio for you out of mutual funds and then stop charging you. And you're just in the funds until you come back and say you want to reassess because your life has changed and maybe your risks or your goals have changed. Stock portfolios are the hardest and the riskiest. Picking stocks is pretty much not something to try at home unless you're willing to dedicate many hours a week to it and you have the right personality type. There are a lot of personalities that do not work well with investing in stocks because you are motivated by social cues which actually tend to work against you in the stock market. In particular, I think it works best if you don't want to be someone who is liked by people. It's better to be an introvert than an extrovert, because if you are an extrovert, you like to be part of the crowd. You end up being part of the crowd in the stock market. And when you're part of the crowd, you're buying at the top and you're selling at the bottom. None of these is easy, none of it's without risk. So I always say that before you start taking any of your investment money and putting it into stocks and bonds, there's a lot of lower risk investments you can do in your own life. You can install solar on your house if you have a roof that's suitable. You can get your house off fossil fuels, replace that air conditioner with a heat pump, and heat with electricity very efficiently. This is outside the scope of this talk, but I think home improvement is a great area where you can actually do, you can put a fair amount of money and it's much safer than the stock market and often has very good returns. This is the south side of my house. I've probably put, well, I put tens of thousands of dollars into green upgrades of the house. And overall, I think I'm making about an 8% internal rate of return, which is not as high as I've done in the stock market, but at very, very, very little risk. And it's certainly much higher than that I can do in sort of a fixed income investment, which is very similar to the investments I've made in my home. You can also invest in electric equipment. That's my electric EV. And I just pulled out this, made this photo last year. I just pulled out all my electric yard equipment. Not very expensive, but basically between this and the improvements on my home, my life is about 90%, 95% off fossil fuels. I've probably bought 50 gallons of gas or diesel in the last 2 years. You can pay down debt. Again, this is another way not to invest in the stock market. It's extremely low. If you have a mortgage, if you have a car loan, if you pay them down, the only way you could lose that money is if you yourself went bankrupt. You won't have to pay it in the future. It's at a fixed interest rate and absolutely no risk. So let's talk about, you've decided to go with mutual funds and you've already paid down your debt. You still have money to invest, or maybe you have money in an IRA or a 401k. You want to know what types of funds you're looking for. Again, that would go to using an online calculator or talking to an advisor to look at a investment allocation for yourself. You may already have an investment allocation prepared for your non-defossilized funds. You could just copy that. You want to think about what your ethical principles are. I mean, in addition to getting out of fossil fuels, do you want to not invest in tobacco or weapons, or and do you actually want to like focus on companies that are actually just not, as opposed to not bad, are actually doing some good? And then there's the question of whether you're looking for active management or passive management. The theory on passive management is that you basically buy a stock market or a bond index, a fund that basically mimics it. It can be very cheap because it doesn't require a person there making decisions about what to invest in. It's harder to do in clean energy, but it can be clean energy or defossilized funds. There are indexes like when I threw up that slide earlier, the SPY-X is an ETF that's the S&P 500 without fossil fuel companies. If you owned an S&P 500 fund before, you could just substitute that one for one, and you'd basically be done. And there's lots of definitions, so it can be a trick, and I unfortunately am not an expert in investing in mutual funds because I've always gone the stock route. I'm going to look at, oops, back up. Well, actually, one place to find fossil fuel free mutual funds, I really like this website, fossilfreefunds.org. And if you, it's paid for by a nonprofit as you sow, and you can just look at top scoring funds. You can, if you know what funds you own, this site is good for telling you what's there. But this site will score all the mutual funds out there by whether they have a sustainability mandate. Have they said that our goal is to be invested in sustainable companies? Are they, so there's the sustainability mandate. You can sort by that. You can sort by their percentage allocation to fossil fuels. Oh, I sorted negative, so you got the worst ones. You can sort by the average carbon footprint of the companies in the fund. So the lower the better. And then they have a list of Clean 200, the top companies that are actually doing good for the environment, and the more money they have in that, that's more tilting the fund towards actually sort of making a difference. But it'll also get you a more specialized and potentially riskier fund. So it's a great way to find funds. You have to sort of know what type of fund you're looking for, but then you can, like, you decide you want this Parnassus Endeavor fund, you can click through and they'll have more information about it. They say the different fossil-free badges, etc. So you can really delve in and look at the carbon footprint, etc. There are sites that are also affiliated with this. So you can choose the funds from major fund managers. There's how to get in there. And then they also have related sites that look at deforestation-free funds, gender equality funds, and weapon-free funds. And so you can actually look for funds that meet not just your fossil-free criteria, but also some of your social criterias, which you can find there. So moving back to my presentation. Go. So the last method, so stock picking versus indexing, if you're doing your own investing. Indexing, again, is you choose not to try to beat other investors. If you are picking stocks, you're basically saying, I am the smartest person who is, I'm making the decision of which stocks to invest in, who is looking at this set of stocks. So it's like sitting down at a poker player and you're playing against hedge fund managers, you're playing against the professionals on Wall Street. So it's a really tricky, difficult way to go. It can be done, but you have to understand why you think you might have an edge against the professionals. I personally believe I have an edge against other professionals because I focus on fairly small, less known stocks. And so I'm not competing against many professionals. Most of them actually can't invest in a lot of the stocks I'm looking at. One, they haven't heard of them. They don't have a lot of research into them. And they also sometimes often just have too much money. They would move the stock too much if they made a significant investment in it. But so you have to understand why you have an edge if you're going to do stock picking. Otherwise, you're basically playing poker against professionals, and I don't advise it. But some of you are going to do it anyway, and that's what my website is there to help you do. I tend to I give people investments in this write articles about the stocks I like, and you can find stocks that are in every part of the economy that are doing something good to get us off fossil fuels. If you are going to stock pick, you don't need to have 200 stocks. 10 to 20 stocks chosen from different sectors can give you most of the diversification you would get with a mutual fund that owned hundreds of stocks. It won't get you all the diversification benefits, but it'll get you some. There are things called preferred shares, which are somewhat of a hybrid between bonds and stocks, which allow you to get a little bit of both worlds. A good way to find stocks to begin with, to look at, in addition to the stock lists on my site, are going to those mutual funds you saw on the fossilfreefunds.org, looking at their holdings and seeing what you want to buy. And if you wanted to sort of go a unmanaged route that wasn't too expensive, so you didn't want to pay a mutual fund, you can just look at their holdings and buy them in that proportion and then update it every year or so, and you won't do too badly, and you would save a lot on the fees. It's also sort of a good way to dip your toe in selecting stocks. I have a couple stocks here that I currently think are pretty good prices. You'll notice that they're not exactly, I never invest in something like Tesla. I like to choose stocks that, as I said, not a lot of other people are looking at. And I also like to choose stocks that are boring, or stocks that you might not like to talk about at a cocktail party. If you bought a stock because you want to talk about the fact that you own it at a cocktail party, you didn't buy the stock because it was a good investment. And so you're already starting behind the game. One I like now is Covanta Holding Company. Covanta is a leader in waste to energy. They run incinerators. Incinerators, a lot of environmentalists have questions about incinerators, and that's actually part of the reason that this isn't such a popular green stock. But a well-run incinerator does not produce the dioxins that got incineration such a bad name over the last several decades. Right now, this is a good priced stock because it sold off a lot during the COVID crisis, but hasn't recovered as much as the rest of the stock market. They dropped because they did a dividend cut. Their dividend was a little bit too high to be maintained before, but they've been just holding on to it for the last few years, and the crisis gave them a reason to cut the dividend, and that will put them on a much more sustainable financial footing going forward. So it didn't hurt the business. COVID didn't significantly hurt the business. So I mean, I think it's a good company at a great price. Another one I currently like, and I actually don't like a lot of stocks right now because I think the market as a whole is overvalued. I'm generally moving into cash, but I also like this company called Mix Telematics. They offer software that helps large companies manage their vehicle fleets. They sell services to lots of different international companies and local in the US, plus all over the world. They are more international than all of their competitors and tend to be the leader with the biggest multinationals as clients. Unfortunately, they have a lot of clients who are big oil companies. They have a lot of clients in public transit, so bus fleet operators, and they have emergency services. Those first two sectors have been really badly hit by the COVID crisis. And so in the short term, Mix's revenues have also been hurt because they sell subscriptions, and when a company idles a vehicle, they stop paying on the subscription. If and when they bring that vehicle back into use, they'll start paying again. And so I think that Mix has good prospects in the medium term as we come out of the crisis. But right now, you're not paying too much for them. It's green because their telematics software actually helps the fleet owner reduce fuel use, reduce accidents, and reduce insurance costs. The fleet owners stick with it because net, they're saving money from day one, as well as often mostly on the insurance, but they also do save money on fuel. So it's a good option there. If you want to pick, that's the general. I want to move into Q&A. I have some questions from that got sent in ahead of time, but I'd like to just pause, maybe let Vanessa look at the questions that are there and see if there's new questions coming up. Are we getting a lot of questions in?
I do have one question for you. How do you reconcile concerns over national security and dependence on foreign energy with the divestment from domestic fossil fuels?
That's actually one of the easier things to reconcile because the fuels we're shifting to are all domestic. Solar may not, the solar panels may not be built in the US, but once they're here and we're using solar power, that's a domestic fuel source. Wind, same thing. And actually wind turbines are largely built locally because they're too big to ship long distances, especially the blades. Energy efficiency, probably my favorite clean energy sector, is simply using less. So as we use less, if we switch to electric vehicles instead of fossil vehicles, we don't need domestic fossil fuels because we're not using any fossil fuels. So yeah, basically clean energy improves energy security. There's nothing to reconcile. It's a win-win in the same direction. Moving on to some of the questions from the web, we have what are metrics, values for fossil fuels that make clean energy attractive? This was actually also another really easy question to answer because right now, most of the well-known clean energy sources are financially more attractive. Solar on a cost per kilowatt hour is cheaper than, depending on where you are, but a new solar plant is cheaper than a new coal plant to run on a cost per kilowatt hour basis. A new solar plant is cheaper than a new natural gas plant, as depending on how it's run. But like California recently was going to build a natural gas peaker plant. There's a couple places, and they looked at the economics, and basically solar plus batteries can provide the same services for a lower cost. There are some technologies which are not yet cheaper. I mean, there's lots of green energy technologies out there, and some of them aren't. For instance, wave power. Hydropower has always been cheaper, but that depends on your dam, and we're not going to be building new dams. But yeah, they're already cheaper. The reason that solar and wind, et cetera, have not taken over entirely is because of non-price barriers. For one thing, we have a bunch of existing infrastructure, and the incumbents want to keep using it. But there have been many cases where it makes sense for the electricity regulator to actually retire a coal plant early, pay the company that owns it for that coal plant, just turn it off and install solar, and you can still save money. That is not always the case, but yeah, there's the transition. In electric vehicles, the cost to own an electric vehicle, if you drive, say, more than 15,000 or more than even 10,000 miles a year, is lower than a comparable gas vehicle. The biggest barrier to the adoption of EVs is lack of the models that most people want. And car salesmen are just not trained to sell them. A lot of dealerships also don't want to sell them because they have much lower maintenance costs, and car dealerships make a great portion of their money on maintenance. And if they switch to EVs, it's really going to hurt their business model. What tools do you employ to identify stocks and funds that meet your criteria? So there's two people asked this question. I've gone through a few tools for finding mutual funds. I don't use fossil free funds because I don't invest in mutual funds, but it's a great site. For looking at stocks, you can look at the holdings of those mutual funds is a really great way. You have someone else who actually looked at it and decided it was green. My website, Alt Energy Stocks, has stock lists for basically all the publicly traded companies we have found involved in wind power. We've broken down to wind power producers, people who just own wind farms, or people who actually make the equipment. You do have to do due diligence on the stocks, but if you just want to find a list, we have lists. When I come across a new company that I think might be interesting, I actually just go to the company website and I say, okay, what do they do? And I ask myself, okay, is that going to help the environment? And if I think that doesn't help the environment, I stop looking at the company. If I think it does, then I'll research the company and decide whether I think it's actually a good value, whether it's worth buying. But if I really like its business, but I think it's overvalued, I'll just put it on a watch list and I'll wait to see if it ever becomes a good value that I might want. One student asked how the 5 colleges could begin divesting from fossil fuels. How long would it take, and who would have to do it? So the Harvey Mudd has a board of trustees, as do each of the other 5 colleges. Those are the people who would make the decision about how Harvey Mudd and the other 5 colleges' money is invested. Typically in the divestment movement, colleges just don't decide to do that on their own. So I think it's important, if this is important to students, that you actually pressure them to do that. And starting a divestment movement among the students would be a great way to do that, or join one if it is. GoFossilFree.org has a bunch of resources for starting this sort of campaign. And you'll hear from pushback when you talk to people who manage the endowment, that there's going to be a lot of cost to doing this. We can't do it quickly. And really, most of that is bullshit. Hopefully I'm allowed to say that on these Mud Talks. It really isn't, especially for a small college like Mudd that doesn't have a gigantic endowment. The only investments that are hard to sell quickly are non-traded investments, if Mudd owns some actual real estate somewhere, that can be hard to sell. That might take some time. But if it's all financial investments, bonds, and stocks, the actual trading into new investments could be done in a few days. It's the decision that's hard, and getting college boards of trustees to change their minds about this is a long battle, but well worth fighting. And at Mudd, I wouldn't be surprised if they might be receptive, but it always helps to have someone, even if they're already thinking about it, if the students are out there saying this is something we really want, it'll make the decision easier for them. So here's a question, a couple questions together about how do we find out what holdings funds have, which is a good question, as I said, find holdings. And I'll answer that one first. So I'm going to go swap over to another screen again. Here we are, Parnassus. So we found earlier, we found this Parnassus fund, Endeavor Fund. And if you just take that and go to a new web browser and type the Parnassus Endeavor Fund holdings, this is how I found out. DuckDuckGo. Okay, so there's Parnassus Endeavor Fund. I just click, it just takes me to the website of the fund manager. And I go through here, and somewhere down here, it'll give me a list to holdings. Here's income distributions, characteristics. Here they say what sectors it's in, and here's top holdings. If you want to look at the full holdings, you just click through. So how do you find what the fund's holdings are? I recommend a search engine. I just use DuckDuckGo. But it's really that simple. Just have to know the right question to ask. The second part of that question, what do I think about investing in funds managed by companies that also manage fossil fuel funds? It's like I said about advisors. I think we really want to help the part of the industry that's really dedicated to greenery. And one of the best ways to do that is to, rather than giving your money to Fidelity's green fund, find someone like Parnassus or Portfolio 21 or a large number of specialty fund management firms and use their, Calvert, it's another one, and use their offerings. There are plenty ones that actually have enough offerings to build a full portfolio. Then there are some where they just have one mutual fund. New Alternatives is one that I like. So yeah, give your money, but you may not have that option. So if you're investing, say, through a 401k, you have to stay within the ballywhack of the manager that's doing that. And then you just find the best you can in that area. People in 401ks often actually don't even have a green investing option. And then all you can really do is talk to your company and talk to HR and say, hey, I really want a green investing option here. And if you can get enough people at your company doing that, they'll change what is offered. What if I don't have a lot of money to invest? I think a student asked this. So some of the things I mentioned earlier, I mean, if you don't have a lot of money to invest, then you don't have to worry about divesting from fossil fuels, but you still can do a lot for the environment. Paying down debt is a good thing. There's a lot of lifestyle changes that both save you money and reduce your carbon footprint. Simply not being a big consumer. You can switch from beef and lamb to chicken or pork as your meat of choice. Beef and lamb have a fair amount of greenhouse gas emissions because the animals burp methane because when they ruminate. You can even take it one step farther and go vegetarian or vegan, but just getting rid of beef gets you more than half of the way in terms of climate impact of the benefit you would by going vegan. And I personally couldn't do that, but it's a good, it's an option that's easy and it saves you money. A lot of states and localities have weatherization programs. So if you do own a building and you're lower income, there's often large subsidies for improving the energy efficiency of your house. And so that can be a great way to both save money. If you're a renter, I think it's very important to talk to your landlord about energy. If you're already renting from that person, you may not have much impact, but if you're a renter looking at places, you can, it's always ask for past utility bills and talk to your landlord about the energy performance, whether they've done any upgrades. And enough people start talking to landlords, they'll realize it's important, they'll do something about it. Typically rental apartments and buildings are very bad on energy because the tenant pays for the energy, but the landlord pays for the upgrades. And by making this clear to the landlord that energy is important to you, we can help nudge them along to make these investments, which would save you a ton of money for a small investment by them. So you can start a divestment campaign if you don't have money, get the college to do it. You can talk to your parents. Who's paying for Harvey Mudd for you? They probably have some money to invest. And divesting is about your future. And if you make it clear to them, hey, this is about my future, your investments are harming the world I'm going to be lived in, they may be pretty receptive to that. Right now we have an election coming up. I don't think climate has ever been a starker choice between the candidates for president and the political parties. I mean, Trump and the Republican Party, especially recently, have basically been acting as if they are wholly owned by the fossil fuel industry. And the Democrats generally want to do something to help climate. So it's a very simple choice. If your vote is motivated by climate, you have to vote Democratic, up and down the ballot. Other things I won't talk about, but that if it's a purely environmental choice, there's no question, and the choice has never been starker in my entire lifetime between the Democrats. Back when I first started doing this, when McCain was running, McCain was good on the environment against Bush. I mean, it was, but yeah, this is very stark. You can also start a green business. This is just a little hobby horse of mine. At least where I live, we have lots of lawns. California, not so much, I'm sure. Everyone mows with a giant gas mower. They have leaf blowers, etc. They're all enormously loud. They're all enormously polluting, and they don't cost, and they cost the same or more than the electric equivalent. So, hey, you're a student, you want a summer job, start an electric lawn mowing business. You'll be doing great things for the environment and make some money. One person asked if I could comment on the hidden cost of green machines. It seems nobody takes these costs into account when discussing the economics. Now, I think it's an excellent question about the hidden costs. I dispute the nobody takes these costs into account. That picture in the lower right-hand corner, Fleeing Vesuvius, is a book, compilation of a bunch of essays which I was published in, where we were talking about this. One way to measure the hidden costs of various technologies is to look at energy return on energy investment. How much energy does it take to make the thing versus how much energy you have to get out of it. So with fossil fuels, so on this chart over on the right here, basically the numbers on the bottom is you get like between 0 and 70 times of the amount of energy out of the thing as you get in it. Oil, gas, shale are, 10 to 20, 5 to 20. They're getting worse over time. That's what those arrows are. Ethanol doesn't stack up as well. Hydrogen doesn't stack up as well. You have to put more energy in to hydrogen to get it in there. I'd put batteries, but like say wind and solar power versus coal power. They didn't put natural gas power, but basically the energy return on investment of electric fuel sources is far better than fossil fuels. There may be, now that's not the only dimension. You want to be looking at externalities. So fossil fuel externalities are pollution. You're having non-greenhouse gas, typical pollutants such as particulates, such as NOx, such as SOx, the components of smog. You wouldn't get that if you had a hydrogen car. You don't get that with an electric car if the electric car is in turn powered by green energy. But then say with the electric car, there are a lot of materials that go in those batteries. There's cobalt, there's lithium. Mining those things does cause harm to the environment. And so if you were to buy an electric car, you want to make sure that it only makes sense if you drive a lot. If you drive less than $5,000 a year, 5,000 miles a year, then you may actually be doing more harm to the environment by buying an electric car, because the benefit you get by driving it, you don't get very much because you don't drive much. Now, if you drive $20,000 a year, an electric car is definitely a better way to go. The amount of fossil fuel you're avoiding burning makes up for the extra damage to the environment caused by mining all the things that went into the battery very quickly. If you're one of those drivers who doesn't drive that much, you might look at a used car. The used car, well, someone else already made that mining happen, but you can still take the benefit of the displacing fossil fuels when you drive. And used electric vehicles are surprisingly inexpensive. They are often cost the same as similar models of internal combustion cars. But when you're looking at externalities like this, you're almost never going to do better than energy efficiency. If you just don't use energy of any type, but you can still stay warm with better insulation, you can accomplish whatever you want. As Amory Levin says, you still get your cold beer, you still get your lighting, but if you do it more energy efficiently, you're causing less externalities overall. So that's a great option. But so there's hidden cost to every human activity that isn't in the price tag. Fossil fuels have gigantic hidden costs that they don't pay for, not only climate change, but impacts on our health. Green machines, green energy, green transportation, biofuels, they also all have impact. Most of them, in most circumstances, are lower impact than the fossil fuels they displace, but not always. You really have to do a little bit more research. You have to think about it. From an investment perspective, it's a little bit simpler. When we choose to divest from fossil fuels, we're simply saying, yes, fossil fuels are part of the economy. The economy currently wouldn't work without them, but we don't have to be part of the problem. We can let other people invest in them and let them be part of the problem. If you're worried about the mining of lithium, even though lithium is used in batteries, you can find green investments that don't have that impact. One I like for the battery is, well, invest in recycling technology. Umicore is a leading recycler of specialty metals based in Europe. Price isn't great right now, so I don't recommend it as, this is the type of thing you'd put on your watch list, but look at recyclers. They will never probably supply all the metals we need for the batteries we need to switch to electric vehicles, but they're going to do part of it, and they do it with less impact than the miners by far. I simply don't invest in miners, even though they are essential to the transition to green energy. What's happening? I'm trying to advance. Trying to advance. It's weird. I'm going to stop share because maybe something is share screen. Sorry, I'm having technical difficulties here. Can I? My slides have stopped advancing. Okay. Vanessa, you want to come back on? Maybe I'll just answer questions since I'm not getting to my next slide. Oh, I'm not getting to my next slide because I'm at the last slide. There we go.
Not a problem. To be mindful of time, we'll just go with one question, but for all those who did ask questions, I will send the questions to Tom. Tom will answer them, and then I will send it in the follow-up email. So the question that I'm going to go with is, assuming that a fossil fuel company is neither issuing stock or buying back stock, how does investing in the stock benefit the company financially?
Couple of ways. A company with a high, so if you invest in the stock, you are marginally making a difference in their stock price. Supply and demand increases the price. So we'll just say a higher stock price. So a higher stock price sends a signal to a company. One, it makes it easier for them. It makes them know that they can raise money if they need to. It also increases their credit rating, which means that when they do need to raise new debt, then they can. And also executives are often compensated based on the share price. So you're giving the executives an incentive to run the company in an environmental way.
Great, thank you, Tom. Tom, I want to thank you today for sharing your knowledge and your insights with us. Thank you to our audience for your questions and for attending this event. We will follow up within the next week with the recorded video and presentation material. So if you did ask a question, don't worry, we will get back to you. And I want to talk to you about our next Mud Talk speaker, who is Carrie Perlson from the class of '79, who will be discussing keeping ourselves and our organization cybersecurity during COVID-19 on Wednesday, November 4th at 5 p.m. Pacific time. All upcoming events can be found on our online offerings page using the link included in your confirmation email or by visiting alumni.hmc.edu and clicking on online offerings. We welcome any suggestions you may have for upcoming events, or if you are interested in hosting one, please email us at alumni@hmc.edu. Thanks again for joining us and have a great day, everyone. Please stay safe out there.